Welcome to another of our video series where we just filling in around our special lockdown edition of Intuition. And today I have Nick Rogers, one of our asset managers, with us. Nick, welcome. Thanks for joining me.
Thanks, Robin. Thanks very much. And good to test this out with the audience.
Awesome. I trust you're surviving lockdown and your wife and kids are not getting in your way while you still research the markets and do what you need to do?
Look, I think they started a week earlier than the actual lockdown, so there's quite a bit of pent-up energy out there. But no, it's going well. I think they're enjoying the extended holiday.
Yeah, awesome. So Nick, we've seen markets really do some amazing things, and I'm quite certain that as investors receive their statements at the end of March, following on from the end of February, there's been some raised eyebrows, maybe some deep breaths. So with other videos, we've kind of examined some of the stuff that's going on in the property space and in the markets as a whole. But maybe talk to us about what investors should be really doing in terms of their portfolios at the moment and the view they should be taking looking forward.
I think I'm sure everybody opening their March portfolios, there would have been a huge emotion that went through your minds looking at the sort of capital values. Now, I think if we go back to early January, where the market was recovering from a Chinese-US trade deal, things were looking good. Things suddenly turned south on around about the 22nd of January, and since then it's we followed the news. And there's a big sense of unease, in the markets. This is an unprecedented time in terms of a global pandemic. And when looking at your portfolio, it's reflected totally across the shares. Being an emerging market, a lot of South African shares have been sold out first. They're on the riskier side, and a lot of money's flowed back to the United States dollar. So portfolios right now are reflecting very much panic mode. And our advice is not to panic. It's a time where we actually need to remember why we invested in the first place. And that initial meeting with Harvard House, it was all about the long term, and we're getting very caught up at the moment. The news flow is fast and furious. WhatsApps, I know there's a lot of humor on the WhatsApps, but it's a reminder every hour or two of the coronavirus. So our minds are very much playing games, I guess, and we just need to be calm and collected through this time, as the sort of feeling that we're getting from ourselves, the way we view the markets, and how long-term investing should be. The short-term moves like this are volatile, and we just need to be patient for this to pass.
So Nick, as an asset manager, what are the kind of things that you guys are doing in the background, and what are you looking at, and how are you guys playing this as an asset management team from the Harvard House side?
All right. So if you look at the movements, if you look at March, for example, on the 19th of March, the market reached a low for the year on the top 40. And it came from about 50,000 points all the way down to, I think it was 33,000 in the middle of the month. It suddenly jumped up and rallied 19% towards the end of the month. And then it came off a bit early in April. So what we're dealing with right now is huge volatility. And I think we're very cautious to get involved straight away. I think it's a time where we're researching shares that we've liked in the past. A lot we are in portfolios, so it's not a matter of brand new shares, but maybe just making sure that the balance sheets of the companies that we own and want to own are strong. In this environment, debt is a big issue. When the tide goes out, you can see who's naked, I guess is the term. That's sums things up. And so we're looking at good quality shares to add, new shares to add, ones that we've liked in the past but were maybe too expensive. and we're not rushing in. We're raising cash where we can. So shares that have outperformed during this time and shares that have become overweight in portfolios, we're looking to reduce those percentages back down to sort of 7 or 8%. You've then got a cash buffer, and when we feel that the time is right, we'll then put that cash into the market. But we're being very patient. I think the overseas markets will probably rally first before South Africa. Obviously, everyone's aware of the downgrade, and that happened in the midst of all of this. So it added to a lot of the gloom out there. So I think South Africa is on the back foot in the short to medium term. On the coronavirus side, we're just getting into the incubation period. So we'll find out how well equipped we are as a country. And whilst that plays out, the local shares, the banks and the retailers and anything that earns directly from South Africa is under pressure, and it'll stay under pressure. The offshore shares, a lot of their sort of upward movement on the JSE has been because of the rand. The rand is devalued due to the Moody's downgrade, but they will recover the quickest. So we are sitting back. Just sorry to get back to your question. We're sitting back, researching and being patient, and we urge that all clients remain patient with us and put trust in us like you have in the past to see you through this period and pick up the opportunities as they come.
So Nick, you talked about some shares where in some instances you might be taking overweight positions in portfolios. Now, I would assume that those are shares that have outperformed the others. In other words, maybe they've gone up when others have gone down, or maybe they've really been protected on the downside. Can you maybe give one or two examples out of clients' portfolios that clients might be familiar with in that space, where you've been sort of raising those cash from?
Sure. I'll give quite a few examples. We've got shares like Investec Australia. It struggled through the last few years, and then it rallied quite nicely in the last 6 months, and it has held pretty steady. We don't think the growth in Australia is going to be like it could be in Europe or America, and the share has held up, so we will be taking, and have in the past taken, those percentages down and raise cash. Sirius is another one. It's a very well-run South African REIT, and it runs out of German business parks. Quite defensive, and it's held up very well. Germany being the largest economy in Europe, and the business side, it feeds into the online, not having to travel into cities anymore as much as in the past. So these business parks have proved popular, and the shares held up. British American Tobacco, we've watched it go all the way down to below 500 Rand a share in the last 6 months, I think. And it's rallied a good 20 or 25% very recently and held up, especially with the Rand movement now. So it is our largest holding, British American Tobacco in Harvard House, and most portfolios will have this particular share. So we're quite happy to reduce that down back, again to 7 or 8%. Those are 3 examples I can use.
Awesome. And so, Nick, so the message for investors at this point is really just to refocus on the long-term goals. Know that the Harvard House team is continuing to do the research on the holdings in the background, and to allow these events to pass and let markets come back to some sort of normality and an understanding of where we're going into the future.
Robin, yeah, that would sum it up. I think, if we look back to 2008, I know I was sitting in London and in the bank, one of the banks that took the biggest hit. So, that was, a good 12 years ago, and we've seen how the market recovered within a year or so straight, after the financial crisis. We've seen Nenegate in 2015 and massive panic. I think that was South Africa's junk moment, to be honest. but similar reactions to what we're seeing now. And then we saw how, a lot of shares recovered after that, especially the more rand hedge shares. And we've obviously gone through China and the US trade wars last year, recovery there. So if you look back in the last 10 years, we've been through, quite a few, 10 to 12 years, we've been through quite a few difficult times, and the market does bounce back. And if you go back even further and you look at the SARS pandemic, swine flu, all the sort of pandemics that have hit the globe, and what you normally see is a couple of months or less than a year of market drops, and then followed by, as soon as the risk is known, investors pile back into the market overseas, and then that follows through into South Africa. So definitely, Robin, I think let the markets recover. We need to quantify what this coronavirus is doing to the economies around the world. And once that's known and quantified, we can then forecast earnings a lot more, with a lot more certainty, and you'll then see the market come back as it was in the past.
Awesome. Nick, thank you very much for your time. Really appreciate it. Keep up the good work there in quarantine. Don't eat too much of the snacks out of the cupboard. But I hope you and your family stay safe. Thank you.
Well, thanks very much. And to the clients, thanks very much. And just as I said, calm, collected, and patience will pay off for the long term. Thanks very much.
Awesome. Thank you, Nick.